I want to stay on the markets right now. Bring in Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott. Mark, markets coming out the gate 2019 under a fair amount of pressure. How does this sort of set up the rest of the year in your mind? Because to me, it argues that there are a lot of knowns and unknowns out there that are speed bumps, or maybe more.
Well, you're right, Charles. And the fact of the matter is right now we're dealing with more of the unknowns than the knowns. And the big unknown at the moment is what's happening to global growth. I mean, obviously, over the last few days, we've had a couple of releases from the Chinese government, those that are official, and that which is a survey taken by the Caxton Group had reported that manufacturing activity in China is actually contracting. So what measures they've taken so far to arrest their deceleration haven't gotten a lot of traction, obviously, yet. And obviously, that has blowback ramifications to other emerging market economies that source a lot of their activity into China. So at the moment, investors are kind of taking their cue from concerns about global growth and those other concerns related to trade, obviously, and Fed policy, which are still unresolved. And so I expect a rough start that ultimately will be resolved positively before the year is out and still put on a good year, even if we start off on the wrong foot. Yeah,
well, before the year's out, we would hope so. But do you feel coming into the year that a lot of these issues, maybe we're getting to the point where a worst-case scenario seems to be baked in, certainly worse than the news so far? Because what we saw from trade, for instance, the trade war, economically, I mean, an $11 billion hit to a $21 trillion economy, the market shouldn't be down this much.
Well, on that note, I agree. In fact, we put out a note early December 26th and said we thought perhaps investors were taking a worst-case scenario outlook to the derating that's occurred here in the equity market, given the fact that while clearly earnings are set to decelerate over 2019, we expect them to still finish up 6 or 7%. So you put a 13-handle multiple on those forward earnings, and that seems to suggest to us that perhaps we've become overly pessimistic to the prospects for stocks from here and actually why we want to be legging in at or below these levels.
What are the headlines that can turn this around in 2019? We know that headlines played a big role in depressing this market. What are the headlines that we should be looking for that could possibly occur that could actually turn it around?
Well, Charles, I think probably the principal one among others is that we see any kind of movement on the negotiation around trade between President Trump and President Xi of China. That would put, obviously, a great bid into equity prices by way of knowing that it isn't going to metastasize into something more sinister. The other, of course, would be that Fed officials start to come out and talk more communicative on a dovish note, that perhaps what the market has already begun to bake in, which is the prospect of no further rate hikes, is being acknowledged by Fed officials, thereby taking away the concern or threat that they continue to hike rates into an economy that appears to be decelerating somewhat. Not necessarily below trend, clearly, at this juncture, but at least directionally, perhaps having peaked in the middle of last year.
All right, one more for you, Mark. I know you're optimistic about the economy. Share with us, if you can, your growth forecast for 2019.
Well, we expect to still see the growth rate in the U.S. to hover above that 2% potential growth rate mark that the Fed has outlined. And so, therefore, even though we're coming out of probably, something on the order of 2.5% to 3% in 2018, while that glide path will move down toward 2%, we aren't expecting anything nearing recessionary type conditions until at least beyond 2019, thereby making this the largest, or that is longest, economic expansion in U.S. history.
What would the impact of that be on earnings? We all have adjusted our earnings outlook. We know there's no way that we could have maintained that amazing pace established last year. So earnings, where does that come up now?
Well, Charles, I think if you're talking about 2 to 2.5% sustained growth, and if you put what kind of multiplier on revenues that should be associated with that, I think 6 to 7% earnings growth on a year-over-year basis is plausible, and therefore the market should adjust, I think, appropriately to that kind of earnings growth, and barring something more sinister developing along the way, at least lead to an advance in equity prices that is pretty decent and still better than the alternatives in bonds and or cash.
Yes, slower growth should not be conflated with negative growth. And I think more often than not, this is the way it's been reported in the media. Hey, Happy New Year, Mark. It was great seeing you, and we always appreciate your wisdom and the hard work you guys do over there. It's great.
Same to you, Charles.